Hello and welcome back to another chapter of video lectures. In this chapter, we're going to look at Chapter 10, which deals with accounting for liabilities. So we saw the liabilities earlier in the course, right? We know what a liability is. A liability is a future sacrifice of an asset to meet an obligation, right? And that obligation arose from a past transaction, right? And we used a lot of examples earlier in the course of saying, we're a company and we purchase something on account, right? We buy supplies on account, maybe we buy merchandise on an account, and that was our accounts payable. So in this chapter, we're going to get into a little bit more detail about liabilities, what they are, how we record them, and we're going to look at more than just accounts payable. We're going to look at things like notes payable, maybe mortgages payable, and we're also going to get into bonds, right? Maybe we're a company that needs to raise money, and we decide to issue a bond. So we're going to see how we record bonds. Okay, so the past couple chapters have focused primarily on assets. Again, in this chapter, we're just going to look at the liabilities. So the first thing you should be able to do after we complete this video is you should be able to define what are current liabilities. And you should be able to explain the essence of liabilities. So as you see here, we have current liabilities. When we're talking about current liabilities, really it has nothing more to do than time. Okay, so when we're looking at liabilities just in general, right? We have the FASB definition of liabilities, obligations that resulted from past transactions or events that require a company to either pay money, provide goods or services in the future. Okay, so when we're looking at current liabilities, these slightly differ than long-term liabilities. So what differentiates between a current liability and a long-term liability depends on the time frame in which that liability comes due. Okay, so when we're looking at current liabilities, these are liabilities that come due within either the within the year or the operating cycle, whichever is longer. Okay, so if we have accounts payable, right, those were all current liabilities. The reason why they were current is because that these accounts payable were going to come due within the year or the operating cycle. We might have some liabilities that aren't due until maybe 5, 10, 15, maybe even 20 years down the road. Okay, so when we're looking at current liabilities, we're looking at accounts payable and we're looking at our notes payable. There is a difference between the two. Okay, accounts payable, these are amounts due in the short term to creditors, right? We buy something on account, so we order supplies on account. Again, those are relatively smaller dollar amounts, but they're due in the short term, right? 30 days, 60 days, whatever, okay? Usually accounts payable do not accrue interest, right? Meaning if we buy something on account, usually that person or that business does not charge us interest. So that's what we mean when we say that accounts payable, usually, they can be, but usually they're non-interest bearing. Then we get into notes payable, okay? Notes payable involve a promissory note with credit periods, okay? Usually these credit periods are going to be longer than 30 to 60 days, okay? They might be 120 days. They might be, 230 days. The point is that the notes payable, again, are going to be longer than the 30 to 60 days. And notes payable usually do involve interest, right? If we have a notes payable we sign a note. We owe somebody money, 120 days from now. Usually that business or that person is going to charge us interest. Okay? So let's look at an example of an interest payable. Okay? Let's assume for a moment that we are Pomona Corporation and we sign a 90-day note. We sign it on December 1st. Okay? What are we getting for this? Well, we're getting $10,000 with 6% annual interest in exchange for equipment, okay? So we want to buy a piece of equipment to put into operations. We don't have the money for it, but the company was nice enough to say, you know what? Not a problem. You take it now, but you're going to sign a note. You're going to sign a promissory note that says you're going to pay me in 90 days, and that includes interest. We say no problem. So the first thing we need to do is recognize, okay, what am I getting? What do I owe, right? So we're going to debit equipment for $10,000. Nothing new there. We're going to credit notes payable instead of accounts payable, right? Remember, accounts payable are for a shorter period of time, 30 to 60 days. The fact that this is a 90-day note, it involves interest. We're going to credit notes payable, okay? So then we need to recognize that at the end of the year, right, we did this on November 1, come the end of the year, we need to do an adjusting entry, right? We need to accrue an expense. We need to recognize that we have incurred some interest here, right? We've incurred an interest expense for the 2 months, November and December, so we need to record that. Nothing new here, right? We saw how to do this back when we did adjusting entries. The only thing we didn't see is how exactly are we calculating that interest, right? So to accrue the interest expense, we're going to take the principal amount, $10,000, times the annual interest rate, and then we need to multiply that by time. Now, when I say multiply it by time, I mean multiply it by the time period which we need to recognize, right? The interest that the problems always are going to give us, they're always going to be quoted on an annual basis or an annual rate, right? 6% for the entire year. Well, we're not borrowing 10 grand for the entire year. We're only borrowing it for 90 days, right? So we need to calculate that 90 days worth of interest based on that yearly interest rate that they quoted, okay? But we're in December 31st now, and we just need to recognize the fact that, well, we've only really incurred 2 months of interest expense. So that's what I say, and that's very important as long as you understand the principal amount times the interest rate times time, okay? So we recognize $100 of interest expense, and we say, we're going to pay this in the future, so it's an interest payable, okay? So on January 31st, that's the end of this note payable, right? The note has come due, and we need to pay this company. So what are we going to recognize? Well, first thing we're going to do is we need to recognize that we have 1 month of interest for the month of January that we haven't recognized. We need to recognize that. That's where the $50 came from. And again, how do we get that $50? 10,000 principal amount times the interest rate, 0.06, times time, which in this case would be 1/12. Okay? So we're going to recognize that 1 month worth of interest expense. We're going to get the interest payable off the books. We're going to get the notes payable off the books as well. And then we need to figure out how much cash are we paying them. Well, we're paying them the $10,000 plus $150 in interest. Honestly, calculating notes payable and interest is really, really not that difficult to do. As long as you understand, we're looking for time periods here, and we need to calculate that interest expense, and that's just the principal amount times the annual rate times time. Now, the next thing we're going to look at are payroll liabilities. Now, this should be of interest to you, I hope, right? We're going to look at it from the employer side of things. But we work for employers. They pay taxes on the payroll. We also pay taxes on payroll. Okay? So you're going to see exactly how this works, right? So the payroll expense that companies incur, right, for paying employees. Well, they're not just paying the hourly rate that an employee earns. They're also paying taxes. Okay, so when we're looking at the payroll expense, this is really going to be we're going to break it down, and we're going to look at some of the major costs that most firms have when we're talking about payroll. They do have that salaries and wages, but they also have amounts that they need to withhold from our paychecks. Okay, and on top of that, employers themselves need to pay payroll taxes and benefits by the employer. Okay, so what we need to look at are what are all these taxes, who pays what, basically. Okay, so what do we get withheld as employees? Well, right off the bat, we are going to get federal, state taxes. We're going to get Social Security withheld, and we're going to get Medicare withheld. Sometimes, depending on where you're at and who your employer is, they will withhold local taxes. That all depends. Okay. In addition to that, we get other things withheld. If you're lucky enough to have a company that will provide health insurance, normally, a lot of times the company will split the cost of that health insurance policy with you. So we as employees our employer will withhold from us health insurance, maybe any union dues, maybe we invest in a retirement account, like 401k or whatever. They will withhold that for us and make those payments on our behalf. Okay. The employer does have payroll taxes. They have FICA. When we're talking about FICA, that's basically the Social Security and Medicare, right? Remember, when we're looking at Social Security and Medicare, there's two portions, right? There's the employee portion and there's the employer portion, okay? On top of that, the employer needs to pay both federal and state unemployment taxes, okay? We pay some unemployment taxes. It's a very minute amount compared to what the employer has to pay. Okay, so let's kind of break this down, right? Hopefully you guys are in this situation. If not, trust me, you'll be there. So we get a gross pay, right? Our employer says pay you $25 an hour. Okay, great. $25 an hour times 2,080 hours. That's number of work hours in a year. We'll get about $52,000, right? Great. Are we actually getting $52,000? No, right? Because the employee, from our gross pay, we're going to get health insurance premiums withheld. We're going to get FICA withheld. That's the Social Security and Medicare. We're going to get the federal income taxes withheld. We're going to get the state income taxes withheld. And then if we're in a business or we have a job that has union protection, there's union dues. So once we subtract all those withholdings from our gross pay, we get our net pay. Okay, net pay is calculated as the gross pay minus the amount that we withhold. Okay, so how exactly do we calculate some of these, right? How do we calculate these payroll taxes and how do we deal with unearned revenue, right? So let's just look at a quick example of unearned revenue. We've seen this before. What are examples of unearned revenue, right? Well, tickets sold in advance for an event or a concert or whatever, maybe a down payment on merchandise that will be delivered later, right? So remember, because of the revenue recognition principle, we say that revenues are not earned, right, until it has been earned. How do we know when it's earned? Well, either the product is delivered or the service is complete, okay? So we need to recognize that if we get payment for revenue that we have not earned, that's a liability to us. That's unearned revenue, right? So let's look at a quick example. Let's assume that Southwest Airlines sells tickets, right, on June 1st. But we're not going to take our trip until July 15th. Okay, so June 1st, we give Southwest Airlines $300. They do not have revenue, right? Southwest Airlines. What are they going to book? Well, they're going to book cash. They're going to say we have an increase in cash of $300. Why did we get this cash? Why did Southwest Airlines get this cash? Well, they got it because they're going to provide us in a future, or they're going to provide us a service in the future. That's a liability to them. We credit unearned revenue. So once July 15th rolls around, we're getting ready to go on our trip. We go on our trip, we board the plane. Guess what? Southwest Airlines now needs to recognize revenue because they are satisfying that obligation by providing us with a service. How do we book that? Well, we decrease our liability, which is a debit to unearned revenue, and we credit ticket revenue. Okay? So very important to understand and to remember and maybe even memorize. Unearned revenue is a liability. So when you see revenue, don't right off the bat think, oh, it's revenue, I have to credit and increase it. No. Just because it says revenue, we have to look at the type of revenue it is. It's unearned. That means it's a liability. Okay? Bonds payable would not be a current liability. Reason why is because bonds payable, those aren't due within the year or the operating cycle or whichever's longer. Okay? So when we come back, we're going to jump into long-term liabilities and how do we account for those. But very important, just recognizing the types of current liabilities that we have. They're either accounts payable or notes payable, right? We have additional payables that we need to worry about, right? Payroll taxes payable. We need to worry about unearned revenue. Those are also examples of liabilities, okay? So when we come back, we'll look at long-term liabilities. Specifically, we're really going to get into bonds, okay? So tune back in for that video.